Welcome to The Explainer. Today, we're going to break down a really crucial metric for any business that sells physical products: the cost of goods sold, or COGS for short. This is the number that tells you the true cost of making the things you sell.
So let's kick things off with a question. If a company makes $1 million in sales, does that automatically mean it's successful? I mean, $1 million sounds amazing, right? It's gotta be good news.
Well, not so fast, because that big revenue number, it's really just the tip of the iceberg. I mean, if it costs you $1.1 million to make the products you sold for $1 million, you're actually going backwards. The real story of a company's financial health is almost always hidden just below the surface.
All right, so let's take that dive. Let's go below the waterline. The very first thing we need to do is get a real handle on what is often the single biggest cost for any company that makes stuff.
And that big cost is the cost of goods sold. You might also hear it called cost of sales. So what is it? Simply put, it's the total of all the direct costs that go into creating a product. We're talking everything from the raw materials to the wages of the people who actually put it all together. It's purely about the cost of production.
Okay, so I just used a key phrase there, direct cost. But what does that actually mean? Because figuring out what counts as a direct cost and what doesn't is absolutely essential to getting this right.
And here's the clearest way to think about it. It's the cost of making the product versus the cost of running the business. So anything that happens on the factory floor, like the wood for a table or the salary of the carpenter, that's in. But all the other stuff, the things that happen at the head office, like the marketing budget or the CEO's salary, that's out. In fact, here's a brilliant little rule of thumb you can use. Just ask yourself this one simple question. Would this still be a cost even if we sold absolutely nothing? If the answer is yes, you've still got to pay the rent on your main office, then it's probably not part of your COGS.
All right, so we know what's in and what's out. But how do you actually get to that final number? How do accountants calculate the final COGS figure for, say, a quarter or a year? It's actually not as simple as just adding up receipts.
The formula itself looks pretty straightforward. You take the value of the inventory you started with, you add in any new stuff you bought or made during the period, and then you subtract whatever you had left over at the end. The logic is actually pretty simple. What's gone must have been sold.
Let's make this super clear with a quick example. Imagine a t-shirt company starts the year on January 1st with $10,000 worth of shirts already in their warehouse. That's their beginning inventory.
Now, throughout the year, they're busy. They make and buy another $20,000 worth of shirts. So if you add that to what they started with, they had a total of $30,000 worth of shirts that they could have sold.
The year ends, December 31st rolls around. They go back into the warehouse, they count everything up, and they find they only have $5,000 worth of shirts left on the shelves.
So the math is simple from here. They had $30,000 in shirts available to sell, and only $5,000 is left. That means the cost of the shirts they actually sold was $25,000. And boom, that's their COGS.
But here's where it gets really interesting. There's a bit of a twist. That final COGS number, that 25 grand, it's not totally set in stone. It can actually change depending on how a company chooses to value its inventory. You see, companies get to choose an accounting method. One is called FIFO, or first in, first out. It assumes you sold your oldest and probably cheapest inventory first. If your costs are rising, this method gives you a lower COGS and makes your profits look higher. But then there's LIFO, last in, first out. This assumes you sold your newest and more expensive items first. In that same scenario, LIFO gives you a higher COGS, which means lower reported profits, but it can also lead to a smaller tax bill. So this choice has a very real impact on the bottom line.
So why are we getting into all this detail? Why does this matter so much? Because, and this is the key, calculating COGS isn't just some boring accounting task. It's a fundamental tool for actually steering the business in the right direction.
And here is its number one most important job. On a company's income statement, right at the top, you take your total revenue, and the very first thing you subtract is the cost of goods sold. What's left over is your gross profit. And that number is huge. It tells you exactly how efficient your business is at turning raw materials into cold, hard cash.
And it goes way beyond that. When you have a really clear picture of your COGS, you can make all kinds of smart decisions. You can set prices that you know will be profitable. You can watch to see if your production costs are slowly creeping up. You can manage your inventory so you're not stuck with a bunch of outdated products. And, of course, it's a huge deal for taxes, since it's a deductible business expense. Which brings us to our final thought. Understanding your cost of goods sold isn't really about accounting. It's about getting honest. It strips away the vanity of a big sales number and forces you, or any business owner, to ask the most important question of all. After we account for what it costs to make our product, are we actually making any money?